3.8%. That number just dropped. And it's not what Wall Street wanted to see. Here's what's really going on. And what you should be thinking about right now. Inflation just came in at 3.8%. Hotter than expected. And it's not cooling down. The latest jobs report? Also hotter than expected. The labor market is refusing to break. Ken Griffin, founder of Citadel, one of the most profitable hedge funds in history, warned us this was coming. Persistent price pressure. Structural inflation. Not transitory. Not temporary. Sticky. Right now, markets are actively repricing the probability of a Fed rate hike. Not a cut. Let that sink in. The bond market is rattled. Equity investors are rattled. This is a dual threat. And it's hitting portfolios from both sides simultaneously. Rate cuts in 2026? They're looking increasingly off the table. The Fed doesn't have room to pivot when inflation is running at 3.8% and employers are still hiring. At this pace, here's the hard math. The Fed's target is 2%. We're at 3.8%. That's 90% above target. This isn't a rounding error. It's a policy problem. But here's what nobody is saying about this yet. The real danger isn't just inflation. It's the combination. A strong labor market means the Fed has zero political cover to cut rates. And without rate cuts, the discount rate on future earnings stays elevated, which means those sky-high growth stock valuations built on cheap money assumptions. They're sitting on a fault line. The mainstream narrative said inflation was yesterday's story. Griffin said it wasn't. The data is now siding with Griffin. And that changes everything about how you think about the next 18 months. First, bond duration exposure deserves a hard look. Long-duration bonds are highly sensitive to rate movements. In a higher-for-longer environment, that sensitivity can become a real drag on portfolio performance. Second, high multiple growth stocks priced on aggressive future earnings may face continued multiple compression. When the discount rate stays elevated, those far-out cash flows get punished. Third, inflation-resistant assets are getting a second look from institutional money. Think commodities, Treasury inflation-protected securities, TIPS, and dividend-paying stocks with pricing power. These categories historically hold up better when real rates bite. 3.8% inflation. A jobs market that won't quit. Rate cuts pushed to the horizon. Ken Griffin called it, and the data just confirmed it. What does this mean for your portfolio? Drop your take in the comments right now. This conversation is happening in real time. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.